I studied for the past week testing divergences, and to my surprise, I found some pretty groundbreaking information. Look, I make tons of videos on different trading strategies, different indicators, and trading tips in general. And a lot of those said strategies use divergences in them. So it got me thinking, if my strategies use divergences, I think it'd be safe to say I should test them to make sure they actually work, not just believe they work because some guy on the internet told me they would.
Whipping up some sales!
So that's exactly what I did. I wanted to know exactly what you're thinking right now. Do divergences actually work? Can you use them to predict market reversals? And most importantly, do they make money? To test divergences, we need to go deep down to the core of what they actually are. What is a divergence? Google says,
divergence, the process or state of diverging.
Thanks, Google. A divergence is simply when price is moving in one direction on the chart and an indicator is moving in the opposite direction. So for example, the market here is making higher highs and the RSI indicator is making lower highs. This is an example of divergence. See, when price is going up, it should only make sense that the indicator is going up with it. That would be a strong uptrend. When that doesn't happen, the indicator is out of phase, which in return creates a dilemma. This is usually a sign that the market has hit a wall and is likely to reverse in the opposite direction. Divergences work with momentum indicators. So whenever the price swings and the indicator doesn't correlate, the price is losing momentum, which can be either upwards momentum or downwards momentum. And what this does is hints a reversal is about to happen, even if it's just a temporary retracement. If you use divergences, you could have predicted the reversal of the COVID-19 crash. As you can see, price was making lower lows, but the RSI indicator was making higher lows, which indicates strength and a reversal is about to happen, which is exactly what did happen. You could have predicted this crash on the S&P 500. The chart was making higher highs, but the RSI was making lower highs, showing signs of losing momentum, which if we look forward, it crashed pretty hard after this, and you could have entered a short at the very beginning of that crash.
Well, they seem pretty convenient.
So if divergences actually work, that would make them extremely helpful, as you can literally predict when the market is about to move in the opposite direction. That's a lot of power at your fingertips. Now, this is where I hit a roadblock in my testing. As said before, a divergence looks at what direction price is moving, but then it also looks at the momentum indicator to see what direction that is heading. Now, you may be asking,
how is that a problem?
That's a problem because how do we know what momentum indicator to use? Many momentum oscillators generate different divergence signals. You could use price-based indicators like RSI, stochastics, commodity channel index, MACD, rate of change, or you could even use volume-based indicators like on-balance volume, volume RSI, shock and money flow, volume price trend indicator, negative volume index, force index, money flow index, ease of movement indicator. Okay, I'm done. My main point is there's a lot of choices and every indicator is going to give different results. So I'd recommend choosing one you prefer and backtest the shit out of it. Test it on markets you trade the most and see what works best for that specific market. RSI may work well for stocks, but not so well for commodity futures. In the same way, stochastic or CCI may work well for commodity trading, but perform poorly for stock trading. Only backtesting can sort this out for you. So yeah, do that. In these backtests, I use the RSI indicator for my divergences. As you might imagine, backtesting divergence strategies with specific quantifiable trading rules is not an easy task. Actually, when I made this video testing the MACD to see if it actually made money or not, divergences were a part of one of the MACD strategies. And what I decided to do was completely take it out as a whole just because it was way too complicated to test and, to be honest, I was too lazy. But I've gained some courage over these past months and said, F it, let's do it.
It's now time to go into the moment you've all been waiting for. The backtest data.
But before we get to that, check this out. I found this indicator from Chart Prime, which is actually today's sponsor. How I would describe this indicator is like the mega ultra version of everything divergence. It will basically find any and all divergences, no matter how big or small. But this indicator basically does all the work for you when it comes to divergences. For example, it'll automatically identify all bullish and bearish, normal and hidden divergences. So you don't even have to look for them yourself. It will tell you when there's a multi-indicator divergence detected by this blue dot, which means if there's a divergence on RSI, MACD, and a bunch of different oscillators all at once, you'll know about it. It'll tell you when there's a high chance of reversal by displaying this triangle, which signals the market is getting ready to reverse. It'll give you entry and take profit points based on divergences themselves. And this is really just the beginning. It comes with over 12 points of confluence. 12. So if you use divergences and want another tool to up your charting game, I would definitely recommend checking their indicator out. It's a game changer when it comes to divergences. I'll leave ChartPrime's link in my description. Okay, back to the video. Now, I want to say this right from the start. This is a very simple backtest. I'm not this huge hedge fund that can hire thousands of analysts to check different quantifiable strategies and use different formulas to, no. I'm just a guy with the trading YouTube. But with that said, I think I found a ton of useful metrics and powerful information while doing this testing. What I did was tested different divergences on the S&P 500, the SPY to be more specific. So one of the hardest parts for this backtest was trying to figure out how to quantify a divergence. It's kind of hard to tell a computer, hey, this right here, this is a divergence. But I think I found a pretty simple way to do it. I had to quantify what a divergence actually was. First, the close is setting a new day's low. Second, the RSI indicator is not setting a new low. Third, we sell at the close based on mean reversion. The first column in this backtest is the number of days. So as you can see, I tested up to 30 days for a divergence. So say for example, we were on 5. A divergence would only be calculated if it closed at the 5-day low and the RSI indicator did not make a new low within those 5 days. Hopefully that makes sense. The second column is number of trades. This is how many trades it took, or in other words, how many divergences it found. Pretty self-explanatory. This next column is where it starts getting juicy. The profit factor. The profit factor is just calculated as the gross profit divided by the gross loss. So basically the amount of profit per unit of risk, which means values greater than 1 indicate a profitable system. In general, I like my trading strategies to have a profit factor of 1.75 or higher, which as you can see, a lot of these were higher than 1.75, with 2-day divergences being the highest at 4.93. Also, notice how all of these had a profit factor above 1. Next, we have the Sharpe ratio. Sharpe ratio compares the return of an investment with its risk. Here's the formula if you want to check it out. Basically, the higher the number is, the better, which again, the 2-day divergence took the lead with a Sharpe ratio of 4.01, which is really impressive. Next column is percent of winners, which this one was really surprising, like really surprising. Boom, look at the amount of times the divergences were right. Again, the 2-day divergence took the lead at being right 81.16% of the time. Let me say that again, 81.16% of the time, which is absolutely insane. And if you look at all of these, they all had insanely high win percentages, which I found pretty interesting. Then the last column is the one that you've all been waiting for, the average profit or loss percentage. In other words, how much money did it make? 3, 2, 1, nothing crazy. But let me explain. So the highest again was the 2-day divergence with a profit of 1.09% gain. But the cool thing was none of these traded for a loss, which is pretty impressive for just following a strategy blindly based off zero price action or any other trading techniques. But with that said, the earnings weren't absolutely crazy. Here's the equity curve of the highest performing one, which was the 2-day divergence. Pretty steady, but not any insane profit returns. Now, the key thing to take away from all this, divergences are correct a huge percentage of the time. So the idea is right, but what I found from these tests is the profit taking could have been improved by a lot. So if you implemented a strategy and mixed divergences with other trading techniques like price action, support and resistances, trend lines, level 2 data, you can make it an insanely profitable trading strategy using them. So do divergences actually work? I'm gonna say, yeah, hell yeah. I did the same type of video with the MACD indicator to see if it actually made money or not, and the results were pretty surprising. If you use MACD, you have to watch this video. I'm warning you right now, watch it. Go check that out. Thanks for watching, and I'll see you guys next time.